basically going to discuss ESOP accounting and particularly SOP 93.6, which tells us how we should record an ESOP transaction on the balance sheet and how we should measure compensation expense and debt payments as a leveraged ESOP pays down its debt. So after we move on from a basic background of ESOP transactions, I'm going to give you some examples of ESOP balance sheets and entries that are made annually for a leveraged ESOP, a non-leveraged ESOP, and then we're going to discuss some more intricate, detailed issues that arise in recording ESOP transactions. So thank you for joining us. We'll move on with the agenda shortly. My name is Brian Wurpts. I'm Vice President of Plan Administration Services Group for SCS. I'd like to remind everyone now that you can fill out a feedback and evaluation form at the end of this session. And I'd also like to remind you that if you have any technical problems with viewing the webcast or any issues, there will be recording of the webcast available on our SCS Advisors website. So if you miss anything, want to go back and listen to it again, it's available on our SCS website. So with that said, we'll move on with the agenda. First off, I'm going to give a brief overview of what employee stock ownership plans are. Employee stock ownership plans are a type of qualified retirement plan, just like a 401k or profit sharing plan. The differences are primarily that, one, an ESOP must be designed to invest primarily in employer securities. No surprise there. That's what ESOPs are about. They're about allocating employer securities to plan participants. The big difference is that unlike any other type of qualified retirement plan, an ESOP may borrow money. There's a prohibited transaction exemption for ESOPs to use debt to purchase employer securities. So unlike other types of retirement plans, ESOPs are a corporate finance tool. They're a succession planning tool, as much as they are a retirement benefit for participants. So this ability to borrow money or leverage makes ESOPs a popular tool for business succession, particularly in companies that are closely held, family-owned businesses or non-public companies where the alternatives for selling the business may be limited. An ESOP allows a shareholder to sell a company or a portion of a company to the employees on a tax-advantaged basis. Right now, there are about 11,000 ESOPs in the U.S. They come in all shapes and sizes, companies from very small, a handful of participants, to some very large companies. That number has stayed pretty steady over the last several years. We see more and more assets in ESOP companies, but the raw number of ESOP companies has remained pretty much the same over the last 10 years. What are the typical goals in an ESOP transaction? Well, of course, shareholder liquidity is a primary goal. That's often the main reason that an ESOP is established, to make a market for shareholder stock in a closely held business. They might be integrated with a long-term succession plan, or you may have the selling shareholder selling the entire business. We'll see 100% transactions in some cases. They're a tool for corporate and personal tax planning. The sale to the ESOP creates a tax benefit, a tax shelter for the shareholder selling the stock. If it's a C corporation, they can elect capital gains deferral. We're not going to get into too much detail about that, but that's an attractive tax benefit for the selling shareholder. And there are also ESOPs that are created primarily to be an employee benefit, particularly for key employees, means of creating ownership and employee ownership interest within the company on a tax-advantaged, tax-deferred basis, becoming very popular in professional companies, particularly engineering firms and the like, where these firms are bigger than they used to be, and there just isn't a practical mechanism for moving ownership around within those larger engineering firms. So moving on, we're going to talk about how an ESOP works in the initial transaction and day-to-day after that. First of all, the company establishes an ESOP trust. The trust is a vehicle that purchases company stock, either from the shareholders or from the company itself. Sometimes there will be a redemption transaction where the company repurchases stock from a shareholder and in turn sells that same stock to the ESOP. Other cases, the company will contribute stock directly to the ESOP trust. That's typically how it's done in a non-leveraged ESOP, and we'll talk about that as we go through the slides. But in the typical leveraged transaction, and by the way, most ESOPs are leveraged, so that's what we're going to spend most of our time on today. So in most leveraged ESOP transactions, there is a bank or the selling shareholder that's providing financing. Normally that financing is to the company, and the reason for that is not that surprising. Banks and other lenders would rather have a lien on the assets of the company rather than on this ESOP trust, which is only going to hold employer securities. So for that reason, typically the financing, the credit is provided to the company. In turn, the company lends the same money to the ESOP trust. That's sometimes referred to as a mirror or internal loan. But mirror loan is really a misnomer. It often does mirror the bank financing, but there's no requirement that it mirror exactly the terms of the bank financing. In fact, by design, a lot of times the internal note between the company and the trust will be for a longer amortization period. The reason for this is several-fold. One of the reasons is you have more flexibility with plan limitations. 404 and 415 limits will dictate how much can be allocated to plan participants. And sometimes, while a bank is only willing to go 5 or 7 years on financing, you may want to allocate benefits over 10 or 15 years. So we prefer to use the term internal loan because the terms may not mirror each other exactly. Now you may set the transaction up so that the exact same debt service is paid to the bank as is paid into the ESOP. One caution on that, however, is that many companies are debt adverse, and so they try to pay down both the bank debt and in turn, if it's a mirror loan structure, the internal debt as quickly as possible, which may be a good decision from a tax standpoint and debt aversion standpoint, but may have unintended consequences when it comes to benefits planning. What you often see is a lot of stock is allocated quickly during the loan term, and as a result, once the loan pays off, now it becomes a real cash outlay for the company to contribute cash or stock to the ESOP. And now we drop the annual contributions way off. And that sets up something we call in the ESOP community a have-not problem. So you want to think about the loan term if you're setting up the ESOP and what makes sense both from a finance and tax perspective and from an employee benefits perspective. So moving on, once the loan is set up, the ESOP's only source of funds is really the company, contributions from the company or dividends paid on the employer's securities. The ESOP in turn uses these contributions and dividends to repay the debt. And then later, as the shares are distributed or the benefits are distributed, either the company or the ESOP repurchase those shares from the employees. Ultimately, the company has to make good on a put option that each participant holds. So if a participant receives a distribution of stock, ultimately the company or the ESOP trust has to repurchase those shares. If the ESOP trust can't or doesn't, the company must repurchase them. So that gets into what we refer to as the repurchase obligation. We'll talk about that a little bit as we go. Real quickly, just a chart describing that ESOP loan repayment transaction that occurs every year. Basically, contributions and or dividends are paid down to the ESOP trust. In turn, the ESOP pays its debt, the internal note debt. This is principal and interest under the terms of that internal note. The company, in turn, makes loan payments to the bank and or selling shareholder. And as the debt's paid between the company and the trust, shares are released from the ESOP account and allocated to individual accounts within the ESOP trust. Important to note here that it's the payment of the debt between the ESOP and the company that triggers this release. And this is a typical indirect loan structure. We're going to talk about the different types of loan structures as we get further in. So a few things that we want to discuss in SOP 93.6 conceptually. Of course, the AICPA Statement of Position 93.6 gives us guidance on GAAP for sponsors of ESOPs. So this is really, if you will, our ESOP accounting Bible. I definitely would recommend, if you have clients that have ESOPs or if you're an ESOP company, it's not a bad idea to go on AICPA's website and get a copy of the SOP. It's really a pretty well-written SOP. My only issue with it is that a lot of the examples in the appendixes are not really real world. So we're going to try to give you some better examples of how things work in a typical transaction structure. But the main thrust of SOP 93.6 is to better address the complexities of various types of ESOP transactions and to better measure compensation expense. Our old guidance 76-3 basically gave us only a basic overview of how to record the transaction. The big change between 76.3 and 93.6 is that we're measuring compensation expense not on the historical cost of the shares that the ESOP acquired, but on their fair market value each year. So we're going to go into that calculation. That's a bit of a departure from other concepts in accounting. Of course, normally we stick to historical cost when we're dealing with things like inventory and other assets. Here, we're measuring compensation expense on fair market value rather than historical cost. And we'll get into that in some detail. Page 24 of the SOP gives a really nice overview of the different types of loans. They use a little bit different terminology than much of the ESOP community uses. But they're basically leveraged plans, non-leveraged plans. And then there are different debt structures. The first and most prevalent one is the indirect loan. This is where the loan is made by the company, the sponsor or employer, directly to the ESOP. And then there's a related loan by an outside lender to the company. And that lender might be a bank, it might be the selling shareholder, it might be another type of lender. The direct loan, which used to be more common, is a structure where the outside lender lends directly to the ESOP. These days, we normally see a direct loan only in a scenario where the selling shareholder is selling directly to the ESOP with a note. And the main reason for that structure is to get installment sales treatment on the debt payments. You can take the capital gain as the note's repaid. You don't see that structure very often. More often, it's an indirect loan, either after a sale to the company or a redemption by the company, and then in turn, the company selling those same shares to the ESOP. And then third, and the least common structure is an employer loan. This is where the loan is made by the sponsoring company directly to the ESOP, where there's no outside debt. This is least common for the most obvious reason. There aren't many companies sitting with lots of excess cash on their balance sheet, which is almost what's necessary to do this type of loan. Generally, we only see this type of arrangement in a situation where there is sufficient cash, there's a large repurchase, maybe a retiree with a substantial balance, and the repurchase obligation is just too large to manage in 1 year. So we'll essentially re-leverage the ESOP trust by having the company repurchase those shares and then in turn sell the shares back to the ESOP trust with a note. And that's primarily because the contribution would be too large to fit under their ERISA limits. So we're going to look at some charts of the different structures, loan structures. The first is a direct loan, and this is not that common, but we used to see them years ago. This would be where the bank would sell directly to the ESOP and in turn take a note and collateral like they would with any borrower. The ESOP in turn would use the cash to purchase the stock directly from the shareholders. And then there may be a pledge of transaction proceeds. Often the bank will need more security, more collateral than the company stock and the company assets, so it's not that uncommon for shareholders to pledge a portion or even all of their proceeds to the bank to finance the ESOP transaction. Even less common is that direct loan. It's a very simple structure. Company stock is exchanged for a note and collateral from the shareholder or even the company in some cases. The much more common structure is an indirect loan structure. The concepts here are basically the same, but of course there are 4 parties involved. Initially, the company is lending cash to the ESOP. That cash in turn is used to purchase the stock from the shareholders. That stock in turn is pledged as collateral on the company ESOP note, and then in turn pledged to the bank as collateral along with other types of collateral on a loan from the bank to the company. So you can see the cash moving around the table here. Essentially it's coming from the bank, going to the company, lent in turn to the ESOP, in turn used to purchase the stock. Now, if all of this seems a little bit circular, it is, and so what you often need to do is establish a 1-day loan transaction in order for the flow of funds to work. So often you'll need to, particularly in a seller note structure, you'll need to get 1-day financing to, in essence, load the deal. Put the cash in the hands of the party that needs to in turn lend it to the next party. This gets rather complicated, of course, but not an uncommon structure. I'm going to take a question from the audience. The question is, when we talk about leveraged ESOPs with dividends, can we go over the equity schedule and share release of the dividends, both on allocated and unallocated stock? Well, the good news there is we're going to talk about exactly that and look over some examples in just a few slides. Here's another example, employer loan structure, where the company is lending money to the ESOP. Again, not that common. The most common structure is definitely this one. And that's mainly what the coming slides are going to be discussing. A couple other 93.6 concepts. What are the tax implications of the ESOP transaction? Well, for non-leveraged plans, they're pretty simple. The contributions to the ESOP are tax deductible, just like any other profit-sharing plan. The main difference is instead of accruing a contribution and putting cash into the plan, often on the extended corporate filing deadline the following fiscal year, we're putting stock in. So one of the benefits of a non-leveraged ESOP is that you can get a tax deduction without a cash outflow in the case of newly issued stock. But of course, stock and issue new shares, there's a dilution cost with it. But a non-leveraged plan does provide a tax benefit without a cash outflow immediately. And of course, the more common leveraged plans, the debt payments that are funded by contributions are deductible. For C corporations, debt payments funded by dividends are also deductible. They're not earnings distributions. The S corporation equivalent of dividends in a C are not deductible, and we'll talk about that more in a moment. Now, the interest paid on ESOP debt is also deductible, which effectively makes all of the ESOP debt service 100% tax deductible. So if you think about leveraged buyouts and why they're attractive, the main thing that makes them attractive is, one, debt generally costs less than equity, so there's a lower cost of capital for the company. And one of the things that makes the debt less expensive for the company is, of course, the tax benefit in a leveraged buyout, the interest being tax deductible. Well, we get not only the deduction for the interest expense in an ESOP transaction, but we get a deduction for the principal portion of the debt. So that's a pretty profound benefit, tax benefit in an ESOP, leveraged ESOP transaction. Few more concepts. The debt obligations of the ESOP trust are essentially the obligations of the employer. So you'll see that illustrated in a couple of examples here. But since the ESOP trust and the employer are related entities, even in a structure where the company is borrowing no money, but the ESOP trust is borrowing money, that debt is still recorded on the employer's balance sheet. Of course, as we just mentioned, an ESOP transaction is similar to a leveraged buyout. The main difference is instead of extinguishing shares in a buyout where the shares remain outstanding, but they're held in a suspense account, they're not allocated to any shareholder or any ESOP participant until they're paid for. So as the ESOP debt is repaid, and this again is the debt between the company and the trust in an indirect loan scenario, shares are released from suspense and allocated to participants. Now, the employer should recognize compensation expense based on the fair market value of the shares as shares are committed to be released. Tax deductions are based on the cost of those shares. Again, that's essentially the debt, the principal and interest paid on the debt is your tax deduction. But now we're taking compensation expense at market value of the shares we're releasing. So we end up with a book tax difference, and we're going to talk about how that's handled in a few slides. All right, moving on. The accounting for ESOP is non-leveraged ESOP, as we said, is essentially the same for any profit-sharing plan. The difference is that we're issuing stock, and that might be newly issued stock, treasury stock, or shares we're redeeming from other shareholders, and in turn contributing to the ESOP. The board declares a contribution. They might declare a contribution in the form of X number of shares of common stock. They might declare it in the form of $300,000 worth of employer securities. Can take a few different forms, but when stock is contributed to the ESOP, the company receives a deduction for the value of those shares that we're contributing. Doesn't actually have to contribute them until the extended deadline for the corporate filing of the 11/20, just like with any retirement plan. There's a question from the group. If a company repays the bank faster than the ESOP repays it, then the acceleration amount is not deductible initially. That is correct. And as we were talking about the mirror loan structure, that's the primary reason that many ESOP transactions are designed to mirror company ESOP trust transactions versus company bank transactions. The sponsor wants good matching of the cash outflows to the bank with the tax deductions generated by the contributions to the ESOP. So that's primarily the main motivation for having a mirror loan structure. And there's nothing wrong with that. That can be a prudent way to design your transaction. I would only point out that you want to take a step back and evaluate from a benefits and repurchase obligation perspective and weigh the benefit of having that fully sheltered cash outflow versus the downside of allocating a lot of benefit early on with no plan to allocate stock after the loan pays off, and also the impact of making large contributions to an ESOP in the initial years and what impact that has on repurchase obligation. Of course, the faster stock is allocated within the plan, the faster the repurchase obligation kicks in as people leave, retire down the road. Okay, jumping back to our case study here, I want to go over some we'll go over the non-leveraged plan example real briefly. The company in this case is determined that it's making a $500,000 contribution to the ESOP. These are going to be newly issued shares. The value to be determined by an independent appraisal. Incidentally, an independent appraisal on a stock contribution is not required, which is surprising to some people. There is a requirement that an ESOP receive an annual independent appraisal. So once the ESOP is established and holds stock, there needs to be an independent appraisal each year. But a contribution of stock in kind does not necessarily require such an appraisal. So a question that often comes up is the board has decided to contribute shares to this non-leveraged plan. How are we determining the value for purposes of the tax deduction, tax return, etc.? Well, the answer is for tax purposes, you have to have a reasonable estimate of the fair market value. And of course, a lot of companies will wait to file the 1120 until they have an independent appraisal in hand. It's always a prudent thing to do, but just want to point out here that the independent appraisal is really only required for ESOP trust, not for the contribution of stock in kind. There are other types of transactions between the trust and the company or any other party in interest where that independent appraisal is absolutely required. So don't want to confuse that. The only time it's not required in an ESOP transaction is when stock's contributed in kind. Any purchase or leverage purchase of shares does, of course, require an appraisal. So in our entries here, typically we're just recording a payable for the pension contribution, and we're recording compensation expense equal to the fair market value of the property contributed. And then, of course, when the shares are issued or acquired and in turn contributed to the plan, we're netting out that payable, and we're issuing common stock at a $1 par value, and we're making an adjustment to paid-in capital accordingly. Moving on to the more complicated leverage plan, we're going to use these assumptions throughout the coming slides. This is going to be a $10 million leveraged ESOP transaction. We're selling 100,000 shares of common stock at $100 a share. And our structure is an indirect loan. So the bank is financed, finance this transaction by making a 5-year loan to the company. And then we've in turn done an internal note with a 10-year amortization of $1 million per year plus accrued interest. And these internal notes are typically structured with debt payments occurring only annually, just to ease the administrative burden of recording these transactions. And of course, the bank debt is more likely monthly or quarterly payments. In our example, the bank interest rate is 7% and the internal note is 4%. This is also acceptable in your structure. The bank rate and internal note rate can be different. Now, establishing the entries for the leveraged ESOP, a few things to point out here. One, we're recording the bank debt, and in this structure that's intuitive because, of course, the company is borrowing money directly from the bank. We're setting up a note payable for the $10 million. We're in receipt of cash of $10 million. And then in turn, we're lending that same cash, $10 million, to the ESOP trust, and there, of course, is a note behind that transaction. So one might infer from it that we're setting up a note receivable for $10 million from the ESOP trust. Well, this is where SOP 93.6, that concept of related entities, is very important. We don't view that $10 million receivable from the ESOP trust as an asset. And we'll sometimes see ESOP transactions recorded this way with a $10 million asset offsetting the note, and essentially in that type of structure the company's equity section is more or less unchanged by the transaction. But instead, SOP 93.6 says we're not recognizing an asset for the receivable from the ESOP. After all, the ESOP's only source of income is contributions and dividends paid by the company. Essentially, we're going to record this not as an asset, but as a contra equity entry. So you get the rather unusual contra equity account when we're setting up the ESOP, a leveraged ESOP. So here we're setting up a $10 million debit for the contra equity account. And of course, as you've already surmised, that makes a bit of a mess of the equity section. And we'll talk about that as we go on. So we've recorded the leveraged ESOP, and now the company has in turn made its first payment to the bank. Well, of course, we're debiting notes payable for the payment, we're recording interest expense, and we're recording the cash going out the door. That's all pretty standard for payment on a bank debt. Essentially no different for the leveraged ESOP. Now in turn, the company has made a contribution to the ESOP. And in our example, remember the shares had a historical cost or a cost basis of $100 a share. The fair market value of the shares is now $60. The shares are committed to be released, and we're using the principal method, and I'll talk about the two methods in just a moment. In this case, we've paid $1 million of principal on a $10 million debt. We're using the principal method, so our fraction to determine the shares released is simply the principal paid for the fiscal year over the beginning loan balance. That gives us a 10% release. We acquired 100,000 shares, and remember they're all in suspense until they're paid for. In this case, 10% of them are paid for, and we're committing to be released 10,000 shares. So, talking about a couple concepts here. First of all, the difference between the principal method and the principal and interest method. The principal method is the simplest, of course. We're simply using the fraction where the numerator is the principal paid and the denominator is the loan balance at the beginning of the fiscal year. That's acceptable for any loan structure of up to 10, with an amortization of up to 10 years. For longer amortizations, we have to use the principal and interest method. We must use that method if the amortization is more than 10 years. In some cases, we'll use the principal and interest method for periods shorter than 10 years. What you want to look at is the pledge agreement and the loan agreement and the plan document, and they're going to point you to which method should be used for a particular plan. Another concept here is, of course, the drop in the value of the shares in this case. Most leveraged ESOP companies, particularly privately held companies that are evaluated by an independent appraiser, are valued on a discounted cash flow basis. And of course, a discounted cash flow basis deducts debt. And the company in this transaction has taken on $10 million worth of debt. So it's typical for the fair market value of shares post-transaction to drop. And they'll drop roughly proportionally to the percentage of the company that's sold in the transaction. And we'll talk a little bit more about that in a moment. The last concept on this slide, and I've just gotten a question about it, is when shares are committed to be released. There's a bit of a debate, and I think the SOP is pretty clear on this topic, but the concept of committed to be released is not the legal concept of when shares are committed to be released. The legal concept is shares are released when the debt is repaid. The pledge agreement will specify when the debt is repaid, shares are released from suspense. From an accounting perspective, shares are committed to be released before they're legally released. And paragraph 15 of the SOP talks about this topic. It says accounting recognition should occur when shares are committed to be released, which may occur before shares are legally released. These shares have not been legally released but relate to services rendered during an accounting period. So we want good matching. We want the compensation expense to be associated with the period for which the services are rendered. So it's quite common for the loan payments in a leveraged transaction to occur after the close of a fiscal year. Well, the contribution or the board's intention to make a contribution essentially commits those shares to be released, and in my view, creates compensation expense based on the market value of those shares, even though we may not legally release them until substantially into the following fiscal year. And of course, they're compensation for services that were rendered in the fiscal year for which the board made the contribution. So it's not much of a stretch to connect those dots from that perspective. Okay, jumping back to our example, in our leveraged plan case study, the company makes its first annual contribution to the ESOP, puts $1.5 million into the plan. The plan in turn writes a check back to or transfers back to the company $1.5 million. What are we recording? Well, we're recording compensation expense, and our compensation expense is the fair market value of the stock that we're allocating. Shares committed to be released in our example, 10,000 here. So we're taking 10,000 shares at $60. We're recording $600,000 in compensation expense. Our interest expense is $500,000, contribution of $500,000 to pay interest on this transaction. What do we do with the difference? Well, the difference becomes an adjustment to paid-in capital. This is not that intuitive, but one way to look at it is it becomes a permanent book tax difference. It's a difference that doesn't reconcile itself. In our case, we're taking a deduction for tax purposes, $1 million expense for the principal on the ESOP, and we're only recording compensation expense of $600,000, so it becomes a paid-in capital adjustment. Now, when the note between the company and the ESOP is paid, we're of course debiting cash for the same $1.5 million. We're crediting interest expense. Not intuitive here, and there are a few different ways to do this. But the reason we're doing this is the SOP says that interest expense on a transaction between the ESOP trust and the company should not be recognized in an indirect loan structure. It is recognized, of course, in a direct loan structure where the company is making a contribution to the ESOP and the ESOP is in turn paying the creditor directly. We're recording that interest expense in that case. But in the case of an internal note or internal loan structure, these two related parties have lent and borrowed money from each other. We're not recognizing an expense for the company and then in turn interest income from the ESOP payment of the debt. And that's not too surprising. It's fairly intuitive. We're not overstating interest expense or interest income in that case, because the real interest expense that counts here, that's important, that measures the performance of the company, is the interest expense paid to the bank. That's also the nexus for the tax deduction. The interest expense paid to the bank is tax deductible, of course. The interest expense paid into the ESOP and then interest income coming back is not deductible, of course. It would be a wash even if you were recording the transactions. But in essence, SOP 93.6 doesn't have us even recording the transaction. The most common thing we see done is to net these two entries, and you might net them through the same account. You could handle them through pension expense. You can handle them through interest expense. A few different ways to do it. But in essence, at the end of the day, while we need to move that $500,000 between the company and the trust and back to the company, because literally we treat the legal terms of the note as though they're two unrelated parties, so the cash has to move back and forth. Or alternatively, the company forgives $500,000, but you still have to document that forgiveness. But at the end of the day, we're not recognizing interest expense or interest income between the two related parties. Now we're just modifying these assumptions just a little bit and using dividend-paying stock. Often it's preferred stock. In this case, same 100,000 shares, but we've got an annual preferred dividend of $5 a share. Again, same indirect loan structure, same note terms. Now, except for booking the issuance of the new stock to preferred rather than common, and there may or may not be new stock issued here. Sometimes the company's recapitalized to structure preferred so that the ESOP can acquire preferred stock. And the main reason for that is twofold. One, in transactions where the ESOP must acquire a minimum of 30% of the company in the tax-deferred transaction structures we talked about, the ESOP, as long as the ESOP acquires either 30% of the outstanding shares of the company or 30% of the value of the company, this deferral or tax benefit is available. So preferred stock may be issued because the dividend preference has a value. The valuation firm is going to value that dividend preference in addition to the underlying enterprise value. This is normally convertible preferred, that's convertible to common. The other reason is that dividends received by an ESOP, as long as they're reasonable, are not included in the 404 or 415 limits. So those are the two main reasons why preferred stock is issued. Now the SOP says a couple things about dividends. Dividends on the unallocated stock are reported or treated as compensation expense, fundamentally the same as an employer contribution. Whereas dividends on allocated stock are charged to retained earnings. They're treated much more like, well, they're treated exactly like a regular dividend payment. And we'll go into some detail on that in a moment. So with our dividend-paying stock, our transactions and entries are not that different from the first example. But instead of making $1 million contribution for principal, we're making a $500,000 contribution and a $500,000 dividend payment. $5 a share on 100,000 shares, $500,000 a year. One important thing to point out on dividends is that in order for them to be deductible, they must be paid during the fiscal year. You don't have the same sort of grace period as you do in contributions where you can make the contribution up to 9.5 months later. A dividend is only deductible in the year in which it's paid. So an important thing to keep in mind. In our example, we have the same $600,000 compensation expense, the same $500,000 interest expense, $400,000 paid in capital adjustment, really no different there than the first example. Same interest expense and cash outlays. Just going back to a point on this slide, paragraph 22 again, dividends on allocated stock are charged to retained earnings. In our example, this is year one entry. None of the stock has been allocated in year one. We look at the shares allocated at the beginning of the year to determine the number of allocated shares. So we have no allocated shares in the first year. Of course, the SOP tells us that dividends on unallocated are essentially treated just as employer contributions are treated. So our entries are really no different in a dividend-paying structure than in a straight employer contribution structure. In year two, it's different. In year two, we have 10,000 shares of ESOP stock that are considered allocated. These are the same 10,000 shares we committed to be released in year one. So now in our example, the company's made its second annual contribution, its second annual dividend, and now the fair market value is $65 a share. So the same method is used, but now our numerator is $1 million and our denominator is $9 million. Our release is 11.11%, and our suspense shares are 90,000. Not surprisingly, we're releasing another 10,000 shares. With this structure, $1 million being paid each year and the principal method, we're simply allocating 1/10 of the shares each year. Of course, in reality, there may be principal prepayments, contributions above the planned amount, and often you're releasing more than the scheduled debt payment. But of course, if you stick to the original amortization schedule on this type of structure, you're going to get an even share release when you have fixed principal and the principal method. You have to be careful with that in the design. If you're working with a mortgage-style loan where we're making annual contributions of X dollars and the principal and interest mix is changing each year, you'll get quite a different share release schedule. Because if, of course, on the principal method, we're only looking at the principal paid in the transaction. So a mortgage-style note, the principal is very small in year one and large in year 10. So you want to be careful with the structure, both from a tax deduction standpoint and a benefits planning standpoint. You want to know how shares are going to be released under this structure. Couple of questions that we'll get to as we go on. Want to keep moving on this example. A couple important points here. Now, in order to determine the shares committed to be released and the accounting entries in this example, we need to know what the source was for each type of share released. So we're essentially going through the same exercise, but by type of contribution or dividend. In this case, 500,000 over 9 million. We're allocating 5,000 shares. Not surprising. It's essentially half of the principal paid. The dividends on unallocated stock are 450,000. And this is simply the shares not yet allocated over the total shares held by the ESOP. Now we're dividing that by the same 9 million, and we're getting a 5% release, or 4,500 shares in this example. And again, dividends on allocated stock, you can see the math there. 10,000 shares were allocated out of 100,000. That's $50,000 of dividend on allocated stock this year, applying the same ratio, and getting 500. But I've added a caution there. There's another layer to this equation that we're going to go through. ERISA has this rule pertaining to the use of dividends on allocated stock. And basically it says when dividends are used to pay debt, the shares allocated as a result of those dividends must have a fair market value no less than the amount of the dividend declared on the allocated shares. Now, this is important in a leveraged ESOP. Typically, the value drops. In our example, it declined from $100 to $60 and then to $65 in year 2. So intuitively, we'd expect to see an airball there. We're going to see the value of the shares less than the value of the dividend declared, which was $50,000 in our example. And of course, we talked about this already. DCF model, typical valuation or similar methods, the debt's deducted, and typically we see a post-transaction value less than the transaction price. In this example, it's no different. Run through the same release calculation, and now we're looking at the value of the dividends allocated. We're taking the 500 shares allocated as a result of dividends on allocated shares. That's the 500 shares were committed to be released at the fair market value of $65 a share. So we're getting a value of $32,500. We have a deficit, $17,500. So what do? Well, it depends on a few things. Sometimes it's specified in the plan document. Sometimes it's a determination made by the company or a plan administrator in conjunction with their ERISA counsel. But typically these deficits are made up by either redirecting shares that are released by dividends on unallocated stock or by an additional contribution of shares by the company. Frankly, I see option A far more often than option B. I'd say that's the pretty typical means of addressing that issue. All right. Applying that example, we take the same calculations we've made. We've got that deficit of $17,500 in our example. We have 500 shares that are initially released by dividends on allocated stock, and we determined that we need 269.23 shares to make up this deficit, essentially $17,500 worth of stock. And we're simply moving it from the dividends on unallocated bucket to the dividends on allocated. The ESOP talks about this redirection of shares as well, and it says basically the compensation expense in this example should be recognized on 4,230.77 shares rather than 4,500. Those shares that are redirected for this purpose are recorded as dividends. Okay, so our modified entries. We've made the same cash entries. We've recorded compensation expense, now not compensation expense of $600,000, but of $325,000 for the contribution. That's 5,000 shares at $65 a piece. And now we're only looking at those 4,230.77 shares at $65 each for another $275,000. So whereas in this example we would be recording, if it were all contributions, $650,000 in compensation expense, 10,000 shares at $65, instead we're recording $600,000 in compensation expense. The other $50,000 is retained earnings. Not surprisingly, it's $50,000. That's because we've applied the rule that said we had to allocate shares worth $50,000, and that's exactly what we've done. So now the dividend is recorded as a $50,000 dividend. The dividend on unallocated is still compensation expense. Point out here, of course, that as more and more stock is allocated, compensation expense drops under the structure, and we have more and more dividends paid. So it's a little kinder to the profit and loss statement. Of course, it doesn't have any bearing on the tax implications. The entire dividend, $500,000, is tax deductible anyway for C corporations. So our other entries are essentially the same. So we've made our entries, In this case, the tax implications of those entries are, just as I said, $1.7 million deductible in this case. For an S corporation, it would be much the same, except remember that a dividend for an S corporation, while it may be used to pay debt, is not tax deductible. So it's permissible with the same rules applying for fair market value of stock allocated and so forth. Certainly permissible to use those earnings distributions in this way, but it doesn't generate a tax deduction for the company, so it doesn't flow through to the shareholders' K1. So we talked about this already. We want to move through some of these remaining slides quickly so we have time for any questions. Our book tax difference arising from the tax recognition compensation expense at fair market value is considered permanent. It's adjustment to paid-in capital. Just want to point out a couple of differences as the loan structure changes. The accounting in a direct loan is very similar, but the main differences are we've got the ESOP trust borrowing funds directly, company taking on no debt, but again, as the two are related, SOP 93-6 instructs us to book the ESOP debt on the company's balance sheet as though it were its own. So we're recording a note payable even in a direct loan structure. Now there's no internal loan, so our interest expense is recorded directly. As the debt's repaid, contributions are made, interest expense is recorded and paid out to the bank or selling shareholder. Under our employer loan structure, the ESOP debt is not shown on the company's balance sheet. It's essentially you're recording the same adjustment to or contra equity account, but there's no debt otherwise shown on the balance sheet. This is, again, not a very common structure, but we don't record either interest expense or interest income. And, of course, compensation expense is recognized as the shares are released from suspense. Just providing a sample footnote, it needs to delineate a few things. One typically discusses the transaction briefly. It discusses the allocation of shares, and typically we see allocated, committed to be released, and unallocated, total shares held by the ESOP. And then a measurement of compensation expense. And in this case, it's the $600,000 from our example. You might also see disclosures about repurchase obligation on employee stock ownership plan footnotes. That repurchase obligation, since the company has the obligation to put the shares, if distributed from the ESOP, repurchase obligation may be noted in the footnote, either generically or specifically. Definitely would encourage ESOP companies to think about getting a repurchase obligation study and to look into that if you haven't already. Now, want to get into a couple more detailed topics that arise when you're discussing these entries, because the entries themselves are simple enough, but of course we run into some obstacles when we apply them practically. So we've recorded compensation expense in our example at $60 a share, and we put a neat and tidy entry for $600,000 on the P&L. But of course, in the real world, we really don't know what that stock is worth at the time. At the end of the fiscal year, we really don't know what the stock is worth. The independent appraisal may be months and months away. The independent appraiser may require, audited financial statements. They certainly require final financial statements to do their work, to do the appraisal. That all drags out quite long in some cases. So what do we do? What do we use to determine a fair market value? Well, there are a few things. We can make an estimate and then hold the financial statements open until the appraiser completes the report and adjust the accrual of the compensation expense accordingly to the appraised valuation. do run across some companies that do this, but many want the financials issued and finalized long before that appraisal report is available. So the number of clients that can hold their statements open that long are few and far between, frankly. The other common thing we see is that the company and the accountants will use the prior year's appraisal to record compensation expense. They don't make any adjustment. And then the third option is using management's estimate of average fair market value. This is discussed in paragraph 20 of the SOP. Of course, as I just mentioned, option 1's pretty impractical. Not many companies can wait that long to finalize their financial statements. Option 2 is, I guess, not much of an effort to accurately measure compensation expense. We know basically that last year's valuation is probably inaccurate at this point and not much better than a guess. The third option, and this is discussed in the SOP to some extent, it's management making an estimate of the fair market value. And so the next question, of course, is, well, I'm not a valuation expert. How can we as management make any better guess about the value of the company than, say, using last year's valuation? Well, we're going to discuss briefly a simple method that's a pretty reasonable approach to estimating fair market value. And I'll call this the DCF adjustment method. When our company is valued on a discounted cash flow model or related models where debt is deducted after an enterprise value is determined, one simple method for adjusting this estimate, last year's appraisal, is to simply look at the principal repaid, the debt repaid during a fiscal year. And of course, that's the net debt repaid. If we've taken on more debt, paid down some ESOP debt, we want the delta. We're looking for the net repayment of debt during the year. And then we're simply adding that back to the prior year's share price, essentially isolating the enterprise value from the analysis and looking only at the debt repaid. In our example, our shares were valued at $100 a share. Well, this is actually not pointing back to the entries example we made, but let's say our prior appraisal was $100 a share. We have 100,000 shares outstanding. We repaid $500,000 in debt. We'd simply be taking the $500,000 in debt repaid divided by the total shares outstanding of the company, arriving at $5 a share, the value of debt repaid, and adding it to $100, which was last year's enterprise value minus debt. So in this example, $105 might be a reasonable estimate of fair market value. And again, we're only using this for purposes of measuring compensation expense. It doesn't have any tax implications or other financial statement implications. As long as we're using a reasonable method, you're generally fine. Just a note about, I talked about the ESOP making a bit of a wreck of the equity section. Often you'll see negative equity after the transaction, and that's not surprising on one level. We're, in many cases, highly leveraging companies to do the ESOP transaction. That's going to make a bit of a mess from the accounting perspective. Bankers will often balk at the outcome. They're looking for ratios in their loan covenants. But with a little education about the ESOP structure and what they can expect for the financial statements, you can usually get them past this problem. Certainly, the leverage makes the company a little more risky, but there are some peculiarities about ESOP accounting that makes this look worse than it is. Essentially, the creditworthiness of the company post-transaction is the same as it was pre-transaction. It's just that the financial statements, particularly the balance sheet, are going to look a bit adverse as we book that contra equity account. The shares are still outstanding. It looks like the equity section is a lot worse off than it really is. And of course, the ESOP transaction itself, the tax benefits of it, are a good thing for the company. like all leverage transactions, they can drop the weighted average cost of capital, and that makes it a sound decision for many companies. If the company can service its debt, if it has a reasonable structure on loan terms, what we find is most ESOP companies will quickly service that debt, and the tax benefits of the ESOP structure help them do that. So it's something that you have to discuss with a banker or a bonding company. They have to get comfortable with an ESOP transaction and the accounting for it. Often you'll give pro forma statements before the transaction closes so that they know what to expect and how this works. Now, we've received a few questions along the way, and I'd encourage you to post any more you'd like in the chat section. I'll go through some of these. People will be getting off undoubtedly as we go through them, and that's fine. I just want to reiterate that fill out the evaluation form as you exit. And, of course, you can log on to sesadvisors.com and view or listen to this webcast anytime. In fact, there are several of our past webcasts that you might find interesting, so I'd encourage you to go there. And I'd like to thank all of you for joining us today, of course. Just going back through some of the questions we had during the session, try to address all of these. One question is, upon termination of an employee during the loan repayment period, if the company contributes additional funds to the ESOP trust, how should the additional payment be recorded? Well, there are a few options here, but what's happened is we've allocated shares to a participant, an employee. An employee has left the company, and now it's time to pay them out. And sometimes there's a waiting period. Sometimes there's not. Often small balances are paid out immediately. In some cases, the waiting period is until the loan repays. But let's say we've got a participant, the loan is still being repaid, and we've got a participant benefit to pay out. What are we recording now? The answer is it depends on what you do with the distribution. You could distribute stock in kind. You could distribute cash. That cash can be funded by cash already in the plan. The ESOP, of course, can hold cash. It could be a new contribution coming in, and that's the most typical outcome. The company simply records compensation expense for the cash to be paid out to the participant. In turn, that cash is used by the trustee to pay out the benefit to the participant. The shares that are repurchased are reallocated within the trust. So now we've recorded compensation expense, we've received a tax deduction, and the net shares in the ESOP are unchanged. On the other hand, if we distribute stock, that stock can be retired, and literally the check is written by the company in that case. It could be redeemed and then recontributed, in which case the shares are, the company receives a deduction for the value of the shares as they go in. I'd say in small transactions, the practical administrative answer is fund them with contributions unless you have a compelling reason to do otherwise, particularly with small amounts. The distributing of stock and redemption transactions is just an easier thing, a simpler transaction to do cash contributions. Moving on to the next item. Mark Ambler points out that I think we had $500,000 in interest expense calculated in the example. The note was $100 million at 4%, $400,000. I think Mark is right about that. I think in my original example I had a different rate initially and I changed it to make the math work. Mark, this interest expense is not something we're focused on as ESOP administrators because it's usually ignored for us, but I think you're absolutely right. That should be $400,000, 4% on $10 million. Okay, in our example, a question about why is the company required to make a 1 to 3% contribution on top of profit each year. In our example, there was no requirement for a contribution to be made above profit. I think this is probably a specific case for a specific plan. The answer might be that it may be an ESOP and money purchase pension plan, in which case there'd be a required minimum contribution, and it might be anywhere from 1 to 10%. That could be the case here. In a money purchase plan, the commitment is made by the company to make a contribution of a certain percentage. Not sure in this case exactly what the 1 to 3% is, but that's one possibility. All right. In our example, we talked about when shares are committed to be released, and there's a question about a calendar year corporation, bank requiring 630 12-month interest statements, and shares committed to be released only each 12/31. What's the compensation expense each 6/30? Well, it sounds to me like it's a little bit unclear, but it sounds to me like this is a situation where the debt payments are being made at a different time than the fiscal year. When should the shares be committed to be released, and when are they recorded? Well, under the SOP, they're recorded for the period for which the services were rendered by the plan participants. So if the board is declaring a contribution for a fiscal year, you're making the shares committed to be released for that fiscal year, even if those shares are actually not legally released until 6 months later. If I've missed the mark on that question, you can, of course, give me a call or email me, and I'd be happy to go through the detail on that. There's a question about accessing or printing the slides. Most of you probably received an email with a PDF of the slides. You can write to Alice Simons, our marketing person, or to myself, or give us a call. Information's on the website and on the email Alice sent you, and we'd be happy to email you the slides, the PowerPoint presentation. There's a question about showing dividends on allocated shares as their own line item in the equity section, or to combine them with the share release line. Not necessary to show them as a separate line item. You can make a single entry. And then there's a second part of that question. We mentioned the total dividends in the footnote and discussed how they were recorded. Yes, you typically see a discussion of the dividends in total, and often see a breakdown of dividends on allocated and unallocated. And sometimes you just see the dividends on allocated because that's the only thing in the financial statements that's treated as a dividend. Another question about whether we work with banks that are familiar with ESOPs. We work with all types of banks and banks all over the country, but it certainly helps to work with banks that are familiar with ESOPs. Shorter learning curve for the banker, get comfortable with the credit decision much easier. So it is definitely helpful to work with banks that know ESOPs and do ESOP transactions. But I'll also say that just about any bank, you can bring them up to speed. All right, and then there's a question about EITF issue number 89-8, expense recognition for ESOPs. And this is where unearned compensation account is created. John, I think we need to have that discussion away from the webcast, and I need to brush up on it a little bit. I've read some of the discussion about it, but that's one that I'm not going to be able to answer today. So I'd encourage you to drop me an email, and be happy to go over it with you. And I think that's about it for our questions. So if anyone has any more, fire them off. Otherwise, we'll adjourn shortly. And again, thank you all for joining us.